we should get started.
Let's do it.
And one attendee submitted a chat, which for you all to know, I think chats become part of this record as we record this meeting. And it's Mackenzie from the Voice of San Diego. She's asking if it's possible for us to introduce ourselves and our relationship to the community for the new reporter, as she says. I think we can do that. So I'm going to call us to order, I guess, since this is our first meeting. And this is a meeting of the committee, the Finance and Risk Management Committee for San Diego Community Power. And I'm Cody Hooven. I'm the Interim Executive Officer of San Diego Community Power, or SDCP as we like to call it. So just a little bit of housekeeping. Please bear with us as you have been for the last 7 minutes as we figure out this system. I feel like we did a heck of a lot of prep on this, but we're still a little bit stumbling through this. So we have our agenda up on the screen. Hopefully you all can see it. For the folks that are attending, if you can't see that, let us know. We're also recording this meeting and we'll post it on our website. And I will take us through the roll call. The San Diego Community Power Board is just 5 members total. So the committee is made up of 2 members. And I'll just ask you folks to introduce yourself if that's okay, and that could be our roll call. So maybe Bill, do you want to introduce yourself first?
Bill Baber, the Vice Mayor of the City of La Mesa.
Hello, I'm Mark West, Imperial Beach City Councilman.
Fantastic. And according to the agenda we have posted up here, the election of committee chair is first item. So with that, I'm going to hand it over maybe to you, Bill, to kick that off, if that's okay.
I move to make Bill Baber chair of the Finance Committee.
I would say, Mark, the La Mesa representative will be it. My original plan on this from the day we started writing this thing was to allow alternates to serve on these. And I had this picture in my mind of our city manager, he wasn't a city manager now, but now he's a city manager, who's actually run a public utility of handling these technical things. So he was supposed to be here as my alternate, but as you know, during the COVID crisis, city manager has even more duties than before. So I'm actually, Mark, covering for the guy who's covering for me.
Sounds good.
So La Mesa will be the chair.
Sounds great.
Which means it'll be technically me, but practically it's going to be Greg when he's free of his COVID-19 city manager duties.
Awesome. Sounds great.
Great.
Okay.
And now, Bill, that means you have more work to do because you take over the rest of the meeting.
Okay. I guess is that a motion and a second there? A motion by
I motion,
West,
but
second by Baber. All in favor, say aye.
Aye.
Aye. Okay. Any items to be added, withdrawn, or reordered on the agenda?
No.
Hearing none. Any non-agenda public comments?
None.
Okay, we don't have a consent calendar. So on the regular agenda, there's only one item. Well, there's 2 items. First one is discussion and recommendation on credit and banking services and collateral agreements. Receive, update, and recommend board approval of credit and banking services agreement with River City Bank. Receive, update, and recommend board approval and collateral agreement with Emerald Blue LLC. So can we do 1A and 1B together, or however you want to do it, Cody?
Yeah, that's great. We could do both together. And we actually have Mike Berwanger here. So taking you back a little bit to December, the board approved negotiating with River City Bank for credit and banking services. We had done an RFP process prior to that and wanted to move forward with River City for a variety of reasons, including they are a bank that has a lot of experience with CCAs and the dynamic nature of the startup space that they operate in, especially when they need this funding from a bank, and have, I believe, none, or Rosa can correct me, she's on the call, little to none fossil fuel investment, which was something very interesting and positive attribute by the board, or from the board. And so since then, Mike Berwanger, who's also on the call, he's with Pacific Financial Managers. It's a PFM, it's a financial advisory organization contracted by the city of San Diego on loan to San Diego Community Power to advise us through this credit and financing and banking process. and he's been with us the whole way helping negotiate these terms. And so he is on the call, and he will actually walk us through some of the details and what we're recommending. What we're hoping to get out of the committee today is for you to recommend this move forward to the board next week, and that they recommend approving these agreements with 1A and 1B is with River City Bank, and the second component is a collateral agreement with Emerald Blue LLC. We have both River City Bank representatives, Rosa Kuchicha, on the phone. I wanted to like scroll down and see her, but you could look down and see her face there, I believe. And then also Tara Hammond. So she is with an organization called Climate Solutions, but she is representing the fund, which is called Emerald Blue, which is stepping in to provide us collateral to provide extra assurances to the bank. So they're both available for questions. I'll actually allow Rosa, give her the mic, so to speak, after Mike finishes his presentation, just to say a few words. So with that, Mike, I'm actually going to pass it off to you. And Chad, if you don't mind, Chad Colton is with the city of San Diego, and like me, wears two hats, serves the city, but also serves San Diego Community Power. Chad, I'm going to ask you to scroll down and show the staff report so that folks can see at least some of the content of what we're talking about while Mike talks.
Can you guys see that staff report, item 1?
Yes.
Okay.
So Mike, I'll up to you.
Great, thanks, Cody. So after we met in December, board approved moving forward with River City. The team got to work right away, working through the end of February, so about 2-3 months over the holidays, going back and forth with River City. Primarily, as you would imagine, any bank loaning money to a startup operation has got some due diligence to perform. I think the primary thrust and the primary focus of River City's due diligence, among other things, was really around the pro forma and really making sure that they could pick through that and ultimately get very comfortable. Which they have. I think. Along the way, though, the RFP went out several months before that with a pro forma that was getting, admittedly a little stale from a kind of power markets perspective. So the pro forma was updated during this process so that we had live information. What that meant was that some of the current market conditions were reflected in there, primarily, updated power pricing, as well as resource adequacy pricing, which, for anybody that might be following that closely, has been quite the wild ride, from one day to the next, from month to month. So I think when those were updated, I think River City went back and forth. There was an extensive conversation with us and the team, at SDCP as well as MRW. I think ultimately River City continued to be supportive, continued to hold to their original RFP offer, but they did say, ultimately in order for us to get this approved, we will require, additional $5 million of support here, just to cover that initial sort of chunk of money that we were taking pre-launch, and ultimately for the program as a whole. So, we kind of tapped the brakes at that point. As a team, we regrouped, looking at all options, because we did have a couple other bidders at the time in December. We did, consider going back. We reached out to the banks just to see if they were still interested. They did express that they were interested. However, we were now at the end of February, and every bank, the other two banks, did express their own need to due diligence. Which, was unclear. Obviously, anytime you get into the process with a bank, you never know exactly where it might take you. I think after a lot of consideration, weighing all the pros and cons, we decided that it would be best to stick with River City, given the amount of time and effort that was put in, and to try to pivot towards finding this collateral, and trying to adhere to the request by the JPA participants not to, have the cities, be asked to do this. So we were able to reach out to Emerald Blue, and they were very amenable in coming to support the program. There were several conversations, as you would imagine, with Emerald Blue to make sure that they understood what this was and how it worked, as well as with River City to make sure that everybody was on the same page and kind of, was amenable to the arrangements. Ultimately, everybody's comfortable, and with the Emerald Blue commitment, River City has actually been able to reach final credit approval. So congrats. The money, the much needed money for program launch and continued development has been approved by the bank, which is great. In terms of summary of where we ended up, with River City, really there was only a minor. The only deviation from what the offer was during the RFP process was really this collateral request. Otherwise, I think consistent with what you saw just months ago. We're actually taking 35 million, so that's a subtle update to the 40. It's a 2-year arrangement that can be converted into a 3-year term loan. One of the other, adjustments here throughout the process was, originally half of the line would be made available for cash advances, and the remainder could be used for letters of credit. Well, actually now I think there's no real restriction on that. The program can use as much for either as it sees a need, which is also very favorable for you. The arrangement, again, they held pricing even through March. I haven't said COVID yet. I think I'm required to say that a few times. But even post-COVID, the bank is holding to their offer, which was 1-month LIBOR plus 2%, subject to the floor of 2%. And then, 2% fee on any letters of credit. So that's all continues to be very favorable and was what was approved back in December. So the new piece to this is the arrangements with Emerald Blue, where they are offering, $5 million of collateral. This will be effectively held in a sort of, escrow account, if you will, which will be accessible to River City Bank should the worst happen. It will earn interest. It will accrue to Emerald Blue. There will be interest payments ultimately due from the program to Emerald Blue on this commitment. That will be at the same terms as River City. So they're asking for this. Both entities are getting the same terms in terms of the interest payments that will be due, and then it will be released once a variety of so the milestones are met as the program, matures and it grows from startup. So once those milestones are met, this collateral will be released back to Emerald Blue. So I'll maybe stop there.
What's the time frame of the milestone? Is that 3 years, 8 years? What are we talking?
Well, the real answer is it really depends on how the program does, right? But I think the expectation is probably 2 to 3 years ballpark. The agreement with them has, the agreement with River City and Emerald Blue sort of states in very, very fine detail what those milestones are.
Okay. So in simple terms, not legal terms, this is like they're co-signing. If we don't meet our obligations, it gives River City the right to make a claim on Emerald Blue's money held in account, right?
Up to the $5 million. Yes.
Up to $5 million. Got it. Just trying to put it in English. That's all.
I understand. I was going to stop there for other questions too. So if I've gone a little bit too fast through this, please, by all means, let me go back through it if it's helpful.
And
Mark, do you have any questions?
I'm good.
Also, Rosa Kuchicha from River City Bank is here if you'd like to turn the mic, so to speak, over to her. I'd love for her to say a few words, and then if there's any more questions.
Okay, let's let her talk.
Hi, good afternoon. This is certainly an honor to be a part of your online meeting here. I think we're making history, so I'm happy to be a part of it. I just wanted to say thank you to Cody, to Mike, to Sean, Marshall, to the PEA team for really pulling this together. There's been a lot of changes that have happened between RFP and now, and being able to obtain the credit approval last week was a huge success, and it really wouldn't have been possible without Cody's leadership and tenacity of not giving up. And so I just wanted to recognize that. I also want to recognize Emerald Blue for stepping up. This is really a great opportunity for your community to show their support from the get-go before the program's even launched. And so I think that that's a very important thing to acknowledge. And we're certainly happy to be doing business with you, and are happy to have found a way to make all of this work. With that, on behalf of River City Bank, I just wanted to say thank you, and we're very excited to be in business with you and to help you launch your CCA. I'm sure you've heard a little bit about River City Bank since you have selected us to move forward a few months ago. We've been in this industry for the past 10 years and have helped numerous, I think we're at 15 at last count, CCAs in similar situations as you. And so we've come to learn the basics, and we've also come to learn the fact that things change and things are fluid, and we've reacted quickly. And so that's something that I think we can really bring to the table. I'm happy to answer any questions that you may have. I really just wanted to take the opportunity to say thank you, and to acknowledge all of the hard work that's gone into making this deal happen.
So Rosa, the 15 CCAs you work with, are they all in California?
Yes, all in California.
And not to make you breach client confidences, but if it's on the public record, can you tell us who some of the names, but mostly tell us like the different sizes that you've worked with?
Yeah, sure. We do work with the largest CCA in California, which is Clean Power Alliance, Los Angeles and Ventura counties. So that is currently the largest, and I think will still be. Based on some estimates, it seems like San Diego, your program will be second or third in terms of load size. We also work with Marin Clean Energy. We helped them launch 10 years ago, and in fact under very similar circumstances, where there were community members that pledged collateral to that loan. And so this is so a little bit of a nostalgia for the bank to that respect. We've also worked with Silicon Valley Clean Energy, Valley Clean Energy, Monterey Bay Community Power, and those are kind of the top of the list, and that are similar in size to your program. We work with a number of smaller CCAs as well, just on the deposit and lockbox side.
And I realize results may vary. Check with your tax accountant. But the CCAs you worked with, how soon do they generally clear their collateral holds? That we're talking about. Is that 2 years, 5 years? Is our 3-year estimate close to being on the mark?
Yes, I would say it is. In the past, I think the fastest we've cleared collateral is within about a year, and that was I think a unique circumstance where the cash flows from that particular CCA that were accumulated were much more robust than what was anticipated initially. But I think based on the quality of the pro forma projections and the people that have been involved in making sure that we're on the ball, I think the 2 to 3 year mark is fairly reasonable at this point. It may change, of course, but at this point in time, I think that's reasonable.
Okay. Mark, do you have any questions?
I do. First, with a couple comments, Rosa, I'm very appreciative of River City Bank, and also you guys stepping up to the plate. And when we asked you originally to look at your portfolio and get rid of some of the a couple of your investments, and you immediately stepped up to the plate and did that. So I applaud your bank, and that was a good deed to do with us. So I'm very happy. I'm just going to throw this out there, and we have to talk about it. But what is your bank expecting with economic downturns? Is there anything that you're concerned with right now as we move forward? And I know it's hard to look into the crystal ball at this point, but I need you to look a little bit into it because it's real.
Absolutely. And that's a very fair question, and something that we've been thinking about a lot over the last few weeks. River City Bank's portfolio is very strong. We've got very pretty conservative underwriting metrics, and the majority of our portfolio is in low leverage commercial real estate throughout California. And aside from our CCA exposure, that commercial real estate is the largest asset class that we do hold. We do a number of shock tests throughout the year. We've done that for years, and now I think is a time for us to actually put those tests to the test and see if our underwriting metrics and conservative approach will actually stand the test of time. We're, of course, we can't really, like you said, we can't look into the crystal ball and tell you everything's going to be okay. But I think compared to other banks that are of similar size and similar nature, we will fare this economic downturn a lot better, just purely based on our asset size and our credit quality. I think our executive leadership team is very much on the ball with keeping in touch with what's happening in the market and making appropriate decisions when the time comes. But we're at this point in time, I think we're in the same boat as you and a lot of other businesses where there's just a lot of uncertainty. With that, credit markets tend to tighten, and we're not seeing that yet. We've in fact been busier than ever. Our bank has recently rolled out a number of the Paycheck Protection Program SBA loans for our community members. We're still doing a lot of real estate refinances at low leverage, and so we're not really seeing a slowdown or an impact to the bank as it stands. Does that help answer your question?
That's exactly what I would say. That only thing I would say is you should maybe think about going into more community power and less in commercial real estate for a little bit of time, but that's neither here nor there. And then I also have a statement that I want to for Michael, if you don't mind. Michael?
Oh, sure.
Yeah. So I want to thank Emerald Blue and Business for Good for stepping up to the plate and making this a reality, because this had a lot of there was a lot of cards that we were sitting on here to make this come through. So I'm really happy that they were able to do that. And the group Emerald Blue LLC and Business for Good are great partners in San Diego, and I love the work that they're doing. So thank you very much from the city of Imperial Beach, because it makes me feel even more committed to this when I know that community members are stepping up and being a part of this, because that shows commitment and a real belief in clean power. So thank you. That's all I have. That's it, Bill. Back to you.
Can you hear me or see me? So, Cody, I was trying to, or Sebastian, could you put up on the screen the actual amount that we're borrowing? I just looked at it in the agenda, but so to our River City folks, it's a $40 million line of credit. There it is, for a 2-year term. with an option to convert the line into 3-year terms. So how does that actually roll out? Do you give us it in $5 million increments every X period of time, or we meet certain guidelines? Remember, the public's going to see this, so explain how we would actually get the money.
Yeah, sure. So a couple of different things. So the actual line of credit that we went forward with based on projections is 35 million, so a slight difference. But the projections that we have and that we underwrote to estimated that the credit need would be around 30 million, so you have a little bit of a cushion there. There are phase-ins, and so
can you hold on for a second?
Sure.
Cody, it says 40 million in the staff report. So what is the actual number? Is it the 40 or is it the 35 she just mentioned?
It's actually 35. We
35.
didn't have that. Yeah, sorry, go ahead, Mike.
Michael,
Yeah, it's
go ahead.
35 was the latest number, and it's kind of hot off the press after kind of going back and forth the last week or so. The original amount was 40, but you don't need the 40. You only need the 35. Well, actually, you only need 30, but you want some cushion, so it's 35.
Okay.
Sorry for that confusion.
That's okay. Someone's going to look at this and they're going to see 40, and we're going to be talking about 35, so we need to clarify that. And by the way, Michael, I concur with Mr. West. Thank you for stepping up. We are very appreciative in the city of La Mesa for what you've done.
Great.
Okay.
I don't think,
Go ahead.
did she finish? I think.
Go
I'd
ahead,
like to hear-
Rosa.
Yeah,
Go ahead,
Rosa.
Rosa.
Yeah.
Sorry.
Yeah, so you had asked the question about at what point in time will the 35 million be made available, and you'll see this in the credit agreement that'll come hopefully come to your board next week, but I'll clarify it here. We'll be making the first amount, 5 million, available kind of for the startup phase to cover what's anticipated between now and about the end of this year. There will be a step up to $25 million made available around January, and that's to provide capital for the phase 1 enrollments. And then the additional 10 million, so a total of 35 million, will be made available around June, which will be in anticipation of the phase 2 enrollments.
Okay. Thank you.
So I'd like to make a motion to, since this is not, we're not voting on this, we're just moving over. I just need to make a motion to move it over to the formal board, right? Correct? Is that correct, Cody? Is that all you need, right?
Yes, that's correct. And I want to make sure that, Bill, you mention if there's any public comment received.
Oh. Sorry, Bill.
Do we have public comment, Cody?
No, we didn't receive any as of 2 hours before the meeting, which was the cutoff for us to be able to read them in this new environment. But if we did receive any within the 2-hour window, so between the start of the meeting and 2 hours prior, we will make sure they're part of the record.
Okay. And when you move it on, you will clarify the 35 million number.
That's correct.
Okay, well then I guess I second the motion. In a 2-person committee, if you have a first and second, you have unanimity. So this will be an easy vote here. And do you want to take 1A? Does your motion encompass 1A and 1B both,
Yes.
Mr. West?
Yes,
Okay.
it does, Mr. Baber.
Okay, all those in favor say aye.
Aye.
Aye. Okay, thank you. Thank you, Michael. Thank you, Rosa. Everybody, we really appreciate what you're doing for the community.
Thank you.
Thank you.
Yeah, and thanks to Emerald Blue.
Yes.
Yeah. I'm going to take them out for a drink.
Okay.
Okay, we have item 2. So do Michael and Rosa they get to depart now?
They're welcome to stay or depart, whatever they'd like to do.
Okay. Item 2 is discussion, provide direction on rate discount, power content, and phasing plan. So it's receive, update, and provide direction to staff and Pacific Energy advisors on rate discount, power content, and phasing plan. So this is not an action item. We're receiving this information and giving direction. Now, when you wrote that, did you mean we're we're recommending to the board to give them direction, or are we unilaterally given the direction? Doesn't have to go up to the board.
You are providing a recommendation to the board.
Okay. Okay. So who do you have presenting this, Cody?
So we, with this, we have Pacific Energy Advisors on the line. I'm trying to scroll down and see who is here. It's Sam Kong and John DeLessie from Pacific Energy Advisors. Real side note, real quick, I realized I didn't fully introduce all the faces that you see. Ryan Barron and Nick Norvell are our general counsel for San Diego Community Power. I just want to make sure you all saw them. And then Tara Hammond, you could see her face here. She's representing, or her name, she's representing Emerald Blue, which I mentioned earlier. She was for item 1. So hopefully, Mackenzie, that helped you to see all the names and who they are. Okay, going back to this presentation. So Sam, I believe you're taking over, and what this is I think we've this quite a few times with the board, and we just talked about it in the previous item. This is a very dynamic market, and we're constantly updating our numbers, so to speak. And so Pacific Energy Advisors, who the board approved to be our energy services provider, they are going to be the ones that go out and help us put together our power portfolio and go to market and buy the products that we need based on the regulatory requirements we have to comply with. And based on all the directives that we put in the Joint Powers Agreement or the board directs further as we move forward. I was giving an analogy to one of you, I forget, I think to you, Bill, about the, sorry, I'm very informal because it's such an informal environment, to board member Baber about this analogy is we're going to update this information again and again because we're going to go to market and actually see what type of power we get and what the costs are. But this is essentially confirming our shopping list for them as they go out and see what they can get for us. So this is not a set in stone. This is a checkpoint to say, here's where we're at. Here's what numbers have changed based on the changing market. And here's our baseline. We want to see what levers you want to pull and what adjustments you want to make, and reconfirm those, so as they go out to market, they can look for those things, if that makes sense to you. So with that, I'm going to actually hand it over to Sam to walk through the PowerPoint.
Great. Thanks, Cody. Again, I'd like to thank everyone for the opportunity to help PCP on this important endeavor. Wanted to make sure that John DeLessie is also here from PEA, and please feel free to chime in and add as you see fit. And I think we expect Kirby to maybe join towards the end of the presentation. Kirby is the other co-founder of PEA. John, did you have anything to add to the introduction?
Well, I'll just introduce myself briefly. My name is John DeLessie. I'm co-founder of the firm, Pacific Energy Advisors, and Sam will give a little bit of background about our company, but I'll just say that we're a specialized consulting firm, and we really focus on supporting community choice aggregation programs. And we've been doing it for quite a while. Started in about 2003 and helped launch the first several, and are continuing to support 10 operating CCA programs currently.
Yep, thanks, John. If go to the next slide. So yeah, as I think Cody touched on a lot of these agenda items already, but I think we're just going to talk a little bit about some of the core services we will be providing to you guys. And what we're going to talk about then is what type of products you'll be procuring. We'll talk about how much of which different products you'll be procuring based upon things such as regulatory compliance and maybe board direction. And then we're talking about what sort of, as Cody mentioned earlier, what sort of levers do you have to push and pull to try to control your costs and what are the trade-offs that are involved there. And from once we talk about that, we'll talk a little bit about what your pro forma, your draft portfolio looks like in terms of the current assumptions. And we talk about some sensitivity analyses around what sort of levers there are. And have a brief discussion about what sort of thoughts and get some direction from the board in terms of what direction we're looking to go. And we'll tie it all up with some updates on regulatory filing dates and some upcoming board decisions. Next slide, please. So as John mentioned, you know, I don't want to spend too much time. I think you guys have looked at the credentials for us a lot in helping to select us. So, you know, John and Kirby have been involved with CCA work since 2003 in their previous consulting firm, you know, and helping eventually launching Marin Clean Energy in 2010. We have over 100 years of experience collectively in the utility industry and more than 50 directly in the CCA markets. And we provided technical support in developing 12 CCAs from startup to maturity. The key sort of roles we play and services we do are portfolio management and procurement, risk management that ties together with that, regulatory compliance around those issues, financial planning and rate setting. We'll do some integrated resource plan development. So that's more of like a long-term portfolio planning. And we assist with program development and administration as well. So we have offices, the main office is in Folsom, and their satellite offices in San Diego County, in Solana Beach, and in the San Francisco Bay Area in the East Bay. Next slide, please. These are the core services again, and I'll just hit on some of the key points on the things I mentioned earlier. So portfolio management, so that's the portfolio planning and the analytics around managing your portfolio. Procurement, so once we get that portfolio strategy in place, we go out there and actually do the procurement on your behalf, and including negotiations with the counterparties. Then as part of that, we also do the risk management, and we'll touch more on that a little bit later about your risk policy, but generally the risk management role is to you know, ensure compliance and, you know, develop credit policies and to basically kind of give you a snapshot in terms of what your portfolio looks like, in terms of what your positions are relative to what your targets are, and also what your corresponding risks are. And just below there are just some potential list of the clients that we have. Next slide, please. Financial planning and rate setting. I would just say this focuses more on assisting with preparing your annual budgets, and also a key component of your revenues, the rate setting. Compliance, we talk about regulatory compliance. There's a host of compliance things you need to meet, from renewables to mainly related to the California Public Utilities Commission and California Energy Commission, and just different regulatory agencies. And the other important thing to point out is, like I said, the long-term planning, which is the integrated resource plan, and trying to see what sort of items and what the breakdown is could look like for your portfolio, say in the next 10-year period. Next slide, please. Okay, so here's where we talk about the what is it that we're looking to procure on your behalf. So there are four main components that we will procure for you. So first one we will call system energy. So this is like say energy that you can think of that comes from the California market. So that's through the California Independent System Operator, and that's what you're required to procure power on behalf of your customers in the 5 cities that you represent. So you'll hedge your exposure to the price fluctuations in this market by purchasing in the market, and we'll do it on a scheduled basis, and we'll talk about it in the risk policy in terms of what sort of timing and amounts that you're looking to purchase. The next big one is renewable energy. I think most people know what that is. So we're talking about solar, wind, biomass, geothermal, small hydro, and some types of biofuels. Then there's GHG free energy, sometimes called carbon free energy. So that's coming from non-carbon emitting sources, and pretty much talking about large hydro, which are facilities that are over 30 megawatts, and nuclear as well. Then there's resource adequacy. That's the capacity market that was mentioned earlier. That's the market that has been increasing in price quite rapidly. But this is a requirement to well, I'll talk about requirements later, but it's basically generating capacity that you need to purchase to ensure grid reliability. And it's broken down into system RA, flex RA, and local RA. We'll talk a little bit more about that next. Next slide, please. So to provide some more detail, and I'm trying to go through this pretty quickly to make sure that we have hit all the topics and we have time for discussion at the end, but if there are any questions along the way, please feel free to stop me here. But just a little bit of more detail on renewable energy. There's 3 different types of categories that it's broken down into. There's portfolio content category 1, 2, and 3. So portfolio content categories 1 and 2 are known as bundled RECs. And portfolio, so category 1, you can think of as just your basic, say you're buying energy directly from a solar facility or a wind facility. So it comes with the energy and the renewable attribute combined into one. The category 2 is you're still getting the bundled attribute with the energy, but the attribute isn't necessarily directly from the same source. It could be from a different source. And category 3 is just the unbundled, it's just the attribute itself. It doesn't come with the energy. So those are the main differences, and each one has a different pricing structure. The commission requirement is 75% of the products for the compliance period 4 is required to be minimum of 75%, and the maximum for PCC3 is 10%. So we can do anything we want in between to try to maximize a portfolio. I can tell you right now for the starting point for the pro forma, we're assuming 100% PCC. Next slide, please. A little bit more about the RA market. So as I mentioned, 3 categories earlier. There's a system RA, local RA, and flex RA. So RA, system RA is basically anywhere within the Cal ISO balancing area. So if you look at that little map on the side, that just more focuses on local RA, but just think about it as anywhere in the Cal ISO balancing area, which is pretty much the state of California. On the local RA side, we're talking about the individual locations, more specific to the individual IOUs, investor-owned utilities. And the one that's relevant for SDCP is the Imperial Valley area. So that's where you have the area pointing down there. Just a point to, a thing to point out is that SDCP will be required to source about 70 to 80% of their RA from local. So that's a lot compared to the other CCAs or JPAs. And Flex RA is just basically RA that's required to be available in some of the more volatile ramping up timeframes.
Can I stop and ask a question? It's Bill.
Yeah, sure.
What was the last thing you said about 70 to 80% local that we're?
Yeah. So your
Did I misunderstand something?
Your resource adequacy requirements in terms of what you need to procure to show to the commission is going to be 80%, 70 to 80% comprised of local RA. And
is that different than other CCAs in the state?
Yes, it
Why?
is. Because of your area, right? You're in the SDG&E territory, whereas other CCAs are in other territories that have more local areas that are more relevant to where they serve the load.
In common language, can you explain that to the audience and certainly to me? What is the difference between, or maybe Sean, what's the difference between East Bay and their responsibilities and us?
This is John DeLacy.
Oh, hi, John.
Hi. So it's specific to the investor-owned utility, and so any CCA in the SDG&E area would have similar local requirements. Some of the other utility areas, PG&E, for instance, rather than 70 to 80% of the resource adequacy requirements being local, it's more like 40%. And the reason for that is it's just based on the reliability needs of the system. in this case, the investor-owned utility system. And in the San Diego area, there are more transmission constraints, and so there needs to be more generation near the population centers. And so there's just a higher requirement that those resources be local.
It's actually good though, right? I mean, it has some bad things, but this allows us to be more, to understand where our power is being generated and being supplied to us, right? Didn't this work in our favor because of that? I mean, it can be difficult as well, but am I off on something on this?
Well, I think that there's some good and some bad, and so I think you are highlighting the good. I think the bad is the cost. So
Yeah.
the local product is more expensive.
That's why we have SDG&E. We have some of the highest rates in the country, unfortunately, or at least in California from SDG&E. But we can't control our little area as far as power, how we get our power, right?
Right.
So an example would be if we felt we could buy solar from a farm in Imperial County, they would say that's not local because you're outside the SDG&E territory. You know, the vast part of Imperial County is outside of the territory. Is that how it would play out in practice?
Right. I mean, there's a defined geographic area. It's not necessarily the political sort of, county line, but it sounds like that would be the case. Just one thing to be aware of, since we are talking about capacity and resource adequacy, different types of generators have, you can say, different ratings. So it just so happens that with solar, the ratings for qualifying for resource adequacy are quite low. So that's one of the factors that we need to consider is that it takes a lot of solar. So if you have 100 megawatts of solar, you may only get 25 megawatts worth of resource adequacy out of that. So different resource technologies have different capacity ratings. So that's just something to be aware of, is that we'll probably have to go beyond solar to meet I'm certain we'll have to go beyond solar to meet the resource adequacy obligations.
And just to clarify, so if we do that, we would have to go beyond solar to meet inside our geographic area, right? It would have beyond solar in the SDG&E coverage territory.
Yeah, I think, just in practical terms, we're talking about existing generators that SDG&E owns or has under contract. So a lot of this initially will be natural gas generators for reliability purposes. I think over time, there's an opportunity to build new resources, new storage coupled with solar, things like that. But, on day one, it's going to be the assets that are out there.
Okay.
All right, thanks, John. Okay, next slide, please.
There you go. Sorry, Sam, for that
Yep.
that side note, but that was sort of important to us.
No, and we'll touch a little bit more about it. Also, in terms of, as John mentioned, you've mentioned the positive parts of it, but the negative parts of it is that, local RA is quite more expensive than the system. So here's where we're talking about the, what are the things that are set in stone that you don't have any control over, and what things you may have control over. So on the regulatory side, regulatory compliance, that's what you don't have control over. And so that would be the, say, more focused on the renewable energy. I'm kind of, skipping over the system. System energy is something that you need to procure because you need to supply power to your customers. But the amount that you buy or hedge your portfolio with, but that's a little bit up to your discretion in terms of timing and the targets up to the risk policy. But renewable energy is where you have the, say, renewables portfolio standard that specifies how much you need to have in your portfolio and they break it down by compliance period mainly, but they also have targets by year. So per Senate Bill 100, you're required to have 60% of your portfolio RPS, renewables by 2030. And SB 350, which was the originator before SB 100 came out, also requires that 65% of your renewable portfolio consists of long-term contracts. So that's another requirement. So the voluntary renewable energy procurement targets, so that's something at your discretion. We're going to discuss that a little bit further down in terms of your levers to push and pull. GHG free energy, so the only real requirement out there is that from SB 100 that 100% of your electricity needs to come from GHG free resources by 2045. And of course, your discretion is that you can adopt different targets as you like in between. For resource adequacy, as we talked about earlier, so this is an actual requirement. So there's no sort of choices around this one, but you need to procure for system requirements. You have to procure your adjusted forecasts, and they also want you to get a 15% planning reserve margin, so like a just in case amount. Local requirements are based on your Cal ISO study using a 1 to 10 year weather year and N-1 contingency. And flex requirements, they look at the largest 3-hour ramping period for each month to calculate what that amount is. So RA is non-negotiable. Next slide, please. So what we do to basically how we synthesize all that information. So we got the regulatory requirements in the blue circle there. You have the board mandates or direction, if you want to call it, and we'll talk about that later. Then we have the risk policy in terms of targets and thresholds and timing. So we take all three of those amounts and we boil it down into coming up with the percentage of system power that to be procured and used each year, percentage of renewable energy by product and tenor to be used each year. So, whether you want to use PCC 1, 2, or 3, short-term contracts, long-term contracts, other than the long-term ones that are required. Percentage of GHG free energy each year, and your RA capacity procurement in terms of consideration of compliance mandates. So that's what we're all going, using all three of those items, we're going to come up with some sort of portfolio strategy. Next slide.
Hey, Sam,
Yeah.
before you go to the next slide, can I ask you a question? If we were, some of the, although we're all San Diego Community Power and we're all focused on one goal here, each one of us has climate action plans that are vary in certain degrees. And I'm wondering, I know that board member Mosca has said, he wants his strategy to be more aggressive on his category of energy procurement. Could San Diego Community Power have a renewable energy portfolio that was strictly just category 1?
Yes. And actually the base case pro forma that I'll be showing here is based on that.
Okay, great. Thank you.
Sure. Okay, and just before we even go on further here, just maybe wanted to touch on what are the current market conditions. It'll also maybe help steer in terms of get a better understanding of where we're at right now. So system energy prices, so recent prices, they have decreased and it has reversed the upward trend. But who knows how long that's going to last, and it's gone down even more, I think, with the latest COVID-19, whatever you want to call it, situation. Renewable energy prices, so long-term fixed price PPA, so power purchase agreements for say PV means solar, have declined sharply, but prices for other renewable technologies like wind, geothermal are relatively stable. Index plus contract pricing is also relatively stable, except for PCC2 products, which are have experienced some upward price pressure because of supply constraints. And as John pointed out, renewable energy is something that we keep a close eye on, especially with the increase in energy storage, to see whether how that may impact the whole market as well. On the GHG-free prices, so they've increased recently also due to CCA interest and JPA interest, because what they're doing is they're substituting GHG-free of system energy and higher price renewables, right? So a good example would be if somebody were to say, oh, we wanted to be 100% renewable. They could say, okay, well, because of the market run up in market prices of renewable, we want to be 75% renewable, but 100% GHG free. So you see the prices going up there on that side. And so GHG free pricing may decline after the IOUs allocate their GHG-free resources. There's a pending PCIA power charge and difference adjustment decision, phase 2, that might force utilities to basically allocate whatever GHG-free resources they have. But I'm not sure that's going to be that impactful for SDCP in terms of allocation, but it may be helpful for you in the sense that if you can buy, say, GHG-free energy from nuclear resources, because the prices will be definitely lower than large hydro. Not definitely, but it looks like it will be. And
Sam, I'm sorry. Do we
No, go ahead.
know when we've been hearing that this agreement was going to be done for a while now. And now with obviously the government is not focused on it. What are the chances of it getting done this year? And maybe that's a question for Sean. But.
No, I can answer that one. I'm
Okay.
actually the technical consultant to CalCCA for this PCI decision anyway. So so basically the decision is scheduled for third quarter of this year, but it's by IOU. So I'm talking about specifically about the allocation decision. So PG&E has GHG-free resources to allocate, mainly driven by their Diablo nuclear plant, and they have large hydro resources as well, and Edison as well. I'm not sure SDG&E has a lot there. I don't think, actually, matter of fact, I don't think they really have any GHG-free resources to allocate. But where it might help SDCP help you guys is in the sense that if you want to be GHG-free, if you want GHG-free energy above and beyond your renewables, you could be getting, if you're open to buying GHG-free energy that's coming from nuclear sources, you may be able to get it at a lower price, is what I was getting at.
Sam, it's Bill. Putting our two subjects together, I don't understand the correlation. Please clarify. Going back to the resource adequacy, if we bought energy from the PG&E territory, that does give us credit for resource adequacy, or it doesn't because it's not local? So
that's a good question. So there's system energy requirements and there's local requirements. So if you buy something from PG&E territory, it would qualify as a system RA towards your portfolio. But if you wanted something to qualify for your local RA, it would have to come from the Imperial Valley area.
And I think also, this is John again, it's important to keep in mind the distinction between resource adequacy, which is a capacity product, and renewable energy, other energy that you might buy that would determine your power content. So they're two separate things, and you could be, for instance, 100%, theoretically 100% renewable energy in terms of an energy supply that you offer to your customers, and have a completely separate set of resources for the resource adequacy requirement. So it's a little counterintuitive that way. but I think it'll be helpful just to kind of keep in mind that they're really two different things. The energy that you supply to your customer, well, let me put it this way. When you buy resource adequacy, you don't actually get any energy from that. You're just ensuring
That's
that those
what I
plants
was
are
trying to
available.
grasp.
Yeah.
Is it right? We're basically buying an option on future energy.
Yeah,
Right.
you're in what you're actually doing is
In
paying
common
that
terms.
generator, and they need to make themselves available to the California Independent System Operator if needed. So you're not even in the loop really on that. You're just making sure that those resources are available to the grid operator if needed for reliability.
So in simple terms, I could buy 100% of my actual energy from PG&E territory as long as I have agreements within the San Diego territory to meet this level of resource adequacy.
That's correct. Yes.
You're right. That is super counterintuitive, but it is what it is.
Wait, well said, Bill.
Right. John, is there anything else to add on this slide?
No, I don't think so.
Okay. Yeah, thanks. All right, so here's where we talk about the tools, the different things you can push and pull. And I think I touched on some of them already. So, and this is going beyond just more resources, but also managing revenues. So the first one is, you can obviously control your revenues by the amount you discount SDG&E rates, right? So that's a more obvious one. So and we'll talk about that on the sensitivities, but obviously the bigger discount you provide to SDG&E rates, the lower your revenue is going to be. The other thing is on the phase-in schedule of your load, and we'll talk about that also, and that's one of the drivers behind why the phase-in schedules have been changing, and the new phase-in schedule that we're going to be talking about is also based upon different types of changes that are occurring, not just in the market, but also on the regulatory front that cause us to change the phase-in schedule so that SDCP can maximize its revenue. The next one is RPS targets and choice of the RECs for compliance. So again, RPS compliance targets are, we'll show them on one of the following slides. They start to say 33% in 2020, and they go upward from there. But you can choose to be higher than that, and depending on how much higher you want to be than that, it would determine how much more it's going to cost you, right? So that's one thing. And the other thing is, as we mentioned earlier, depending on how much you want to use in terms of PCC1 or PCC2, you could reduce your costs by somewhat if you choose to use PCC2 RECs for compliance. Another one is GHG-free targets. So if you want to have higher GHG-free targets, then then it's going to cost you. That's according to how much more you want to be higher. And as I mentioned earlier, the pricing could also depend what you spend by if you want to buy GHG-free from a large hydro resource or whether it's from a nuclear resource. We feel that nuclear resource GHG-free energy attributes will likely be lower than large hydro in the future. On the hedging strategy, so this is something you can think about. So depending on what your tolerance levels are and when you plan on doing the actual hedging, it can also help minimize your volatility in procurement costs, right? I mean, an obvious example is, say, for instance, you know how much system energy you're going to need for next year, perhaps by mid to late this year, and you could say, okay, I want to buy all of it, 100% immediately. It may reduce your volatility in procurement costs because you're locked in, but at the same time, it may impact your costs in your bottom line because maybe you locked in at a higher price, right? Or maybe you locked in at a low price and you're a market genius. But that's why we like to use, say, a laddered hedging strategy that has no impact on sort of market outlook. but that's another thing that could help.
I've always been considered a market genius.
Good. Then I'll have to for sure. Also with the surfing spots. Okay, next slide, please. Okay, so this is we're starting to get into the topics before just the board's direction. We're just talking about the different plans that you may have seen in the past, and what they, just a reminder for what they were, and how it's evolved and why. So the implementation plan is probably the one you're most familiar with, right? It's the 3 steps hasn't changed. It's all still 3 steps. But you started out as 3 steps in March 2021 with municipal and some large commercial. July 2021, the remaining commercial and industrial, ag and street lighting. And November 2021, all residential and any remaining from phase 2. So that was based, and Cody, correct me if I'm wrong, or Sean, and you guys who were involved back then, on the market conditions back then. That was the optimal type of structure to maximize revenues and costs. Is that right? I mean, I think that's pretty much the way when we do planning, what we look at.
And I have a question there. Do we feel strongly that this phase-in plan is still the way to go based on the uncertainties as we move forward?
No.
That's a big question. That's probably for Cody more than it is you, Sam. So I don't know.
Yeah.
I mean, what do you think?
I think this is Cody. We're going to speak to that a little bit with Sam. And yes, Sam, to your question, of course, every time we do this type of planning, it's based on the best conditions we have, and we design it to the best that we know at the moment, and it changes every time this gets updated. We also did the first versions with MRW, and now obviously we've switched to Pacific Energy Advisors. You all have much deeper expertise in this specific area, so your numbers are going to look different, and you're going to have a different model to use. So those are some of the reasons for the evolution as we see now, and that we'll continue to see.
Right. Yeah. Thanks, Cody.
And I just think it's important that we're being realistic about this, because I just want to make sure that these are that we really take a look at that and make sure that this phasing plan is the right way to go for the future.
Yeah. The thing is, we whatever the phasing plan happens or changes, it's really not a whimsical thing. It's driven by market conditions or regulatory changes. I
understand. Sam, I got it. I just want to make sure that we kind of put that together before things have drastically changed. So I just want to I'm just putting it on as we need to take a look at that.
Yeah, and to your point, this is why we continue to update these, is because things do change, and this is a point in time. We're just doing a check-in with you all to make sure this is where we're at. Is this where you're still thinking? What do you want to change? And we'll continue to check in again and again because of those reasons.
Yeah.
Thank you. If I didn't say that and the public was out there, they'd be like, "Why didn't he say that?" So I'm just.
Yeah. No, but that's an excellent question. So on the financing plan, so that was a plan that, when we got engaged by River City Bank to basically take a look at MRW's pro formas and planning, and see whether it made sense. And if you look at the reason for change column, really there was a lot of changes in market prices especially on the RA side for wholesale power, GHG free, and causing the prices to basically make the pro forma look different, which merited a change in the phasing plan. And so from that, based upon the changes in market pricing, still stayed three phases, but the first step was with municipal accounts, same March 2021. The second phase shifted 1 month earlier to June 2021 for medium and large commercial and industrial accounts. And then the third phase for residential and small commercial was shifted to June 2022 to try to take advantage of the, say that's more the summer months and without the lower or negative revenues of the winter months in 2022. And that was what was used for the, that's why we just call it the financing plan, for lack of a better name. Now the CPUC came out with a proposed decision 1904-018 to remove seasonality from residential rates, and that impacts the. It doesn't impact the rates on an annual basis, but it does change the phase-in plans because if you're flattening the rates, if you think about it, you're actually, so for the summer months where it's higher, it's lower, and then for the winter months where it's lower, it's going higher. So basically, if keeping the June phase-in, you're basically only taking a hit without any of the benefit. So that merited the change to the third phase from June 2022 to January 2022. Again, now that was driven by a regulatory change, not because of, so there was a legitimate reason for the change. So that's where we're at now, is we're at the base case plan. Cody and I and Sean, we went over what the best way to call it is, whether it's a base case or not, but it's the starting point for what we're going to be showing here. And we'll talk about the details on the what the rate discount, RPS, and GHG free targets were on the next slide.
But to be clear, Sam, this is Sean. Just to be clear as we go along here, that for the benefit of Bill and Mark, this quote unquote base case plan, or whatever we call it, doesn't really matter. This is right now what the team is recommending that the board consider for an amended phase-in schedule, correct?
That's right.
Okay. I think we need to be super clear about, just because there's a lot of information. So that's right now where we're at with it.
Right.
Yeah.
Thank you, Sean. That's right.
Thank you.
Thank you, Sean.
Okay, next slide, please. So a quick summary of the different plans. The first row you see just to show what the RPS requirement is. Then the next line basically shows what the implementation plan RPS targets were. And then the row underneath that is what the financing plan targets were. And then it just shows the next few rows shows what the targets were for GHG free that were above and beyond the RPS targets. And the next couple rows show what the expected, the assumptions were regarding the discount to SDG&E rates. And I just wanted to point out that the RPS target under the financial plan is 60% in 2026. We didn't go quite out that far on this chart, but it is at 60%. But you'll also be 60% GHG free by 2024 if you were to combine your renewable target together with your GHG free target, 56 plus 4. The bar chart there kind of is just to show what you look like against SDG&E. So your blue, SDG&E is green. The dotted orange line is the RPS requirement. And I just want to say that the source for SDG&E information is from their 2019 procurement plan. 21 and 22 was extrapolated from their 2018 data, which was because they have a lot of data blacked out. And 23 and 24 is directly from the plan. And this assumes that they're not going to sell down to their RPS requirement. It just assumes that it is what it is on the plan without selling it off. And 2025 just assumes the RPS compliance. But you can see clearly in all years under the financing plan is higher than SDG&E. Next slide, please.
Oh,
sorry, go ahead.
One question, Sam.
Mm-hmm.
So Oh, wait, never mind. I answered my own question. Never mind. Keep going. Thank
Okay,
you.
I have a question. Maybe this is for Sean. Sean, I thought we were going to be talking about a short-term 6 to 12-month plan, not a 4-year plan. What are we actually recommending to the board here?
Yeah, I'll refer this back, but what you're looking at here is this feeds into the pro forma, the budgeting that needs to be done, and the sort of the projections going out. So PEA will likely procure power that is shorter term to begin with, and then we layer in longer term contracts. But this is an exercise that we do, for the bank, but also just for your own planning purpose. So that's what, I don't know if that answers your question, but that's why you're looking at a 5-6 year planning horizon here.
I think Bill's question is more specifically to what is the decision they're making now.
Yeah.
So your point, you're not making a 5 or 10 or 15-year decision today. You're giving general direction, and maybe Sam or John, you can clarify this if it's near terms, but you're giving general direction for the near term, but every time they run the numbers, they run it over the long term.
That's right.
Yeah, that's right. And again, so this is in terms of your targets. This is something that we don't necessarily need to revisit every month, right? But I mean, as mentioned earlier, normally when you see like a shift in market conditions or regulatory changes, then that prompts another look at your pro forma or your planning. Then we would take a look at it. So the guidance that's being sought here is what sort of targets are we looking at in the coming years, and because that helps us with our procurement. So it goes to the portfolio strategy and what we're looking to procure in the coming year, next year, and so forth.
I have a clarifying question that I think is relevant for this particular slide. Right now, we're just focused, I think, on the RPS piece of this, which if you look in 2021 for the financing plan, which I believe is the one right now that we're looking at, would be 50% at launch, then moving up to 52. Right now, the underlying assumption is that is all PCC1 power.
That's right.
So a question I would have just generally would be, if SDCP decided to move some of the knobs here, which we'll hear from Mark and Bill on, and use instead 75%, for example, 75 PCC1 and 25% PCC2, in your estimation, would that make much of a difference in terms of any kind of savings in cost of power?
Yeah, I mean, so first of all, it would still count as renewable energy, obviously, but the cost of power might go down slightly. Yes, only because the combined price of a PCC2 product with a GHG-free attribute combined is still a little bit cheaper than just a PCC1 product. So the answer is yes, it could.
Okay, so I want to bring that up and bookmark it for you guys, because that may play into some of the decision making around how we manage to still offer a tiny little discount. So I'll just stop there and then keep going.
Well, I think that's important, Sean. I think I'm because it's my question earlier was kind of a lead into that, because I think that there are certain cities inside SDCP that may be willing to pay more to get a higher level of a higher portfolio or category of renewable for energy. So I'm throwing that out. I threw that out there originally to kind of say, hey, look, some of the other cities may want to be able to play a little bit with that dial, if you know what I mean. So, and I know that can make it more challenging too, right?
Yeah. So let's keep going and see what happens with that potential. But I wanted to put that out there because it might help a little going forward.
Okay.
Okay. Next slide, please. So these are the assumptions, the starting assumptions for the base case pro forma that you're going to be seeing. So it has a 3-phase launch schedule that we mentioned earlier. That was the last one. So basically, the key thing to remember here is shifting the June 2022 small commercial and residential to Jan 1, 2022. No discount to SDG&E rates. This is, again, that's a starting assumption. The opt-out rate assumption is 5% for all member cities. RPS and GHG free targets reflect the financing plan that you saw on the previous slide. There's $5 million in funding requirements for 2020, $30 million in funding requirements for 2021, which includes about $500,000 for Cal ISO security deposit, $5 million for lockbox reserves, and the remainder for working capital during the launch year. And just want to show again, so the projected operating results are based on current rate and energy forecast and subject to change. The actual financial performance will depend on SDG&E's 2021 rates, which are currently forecasted, and the final energy pricing as reflected in the contracts that you actually, when you're at the end of negotiations. Next slide, please. So this is the breakdown of the pro forma. It looks more complicated than it is. Let me just go through some of the line items quickly here. So the revenue row here is simply the rate, at a very high level, the rate times the number of megawatt hours, less any sort of things, things such as franchise fees. Operating expenses, the biggest operating expense, as you can see, is power supply. For 2021, for instance, you can see it's 155 million of the 168 million projected. So, and in all the years, it's probably it is the largest expense. And then you have your administrative costs, which is comprised of your staff, your technical and legal services, communications and enrollment, utility service fees, data management services, regulatory fees, and uncollectibles. So the operating margin, so the next row down, operating margin is your net from the revenue and expenses. Then you have the next rows for financing, and this is basically shows a breakdown between interest financing and principal payments. And we will update this based upon whatever you guys come up with for the final agreement with River City Bank. But currently it's based on 3% interest and a payback period of 5 years for the 30 million in working capital, but only 3 years for the 5 million. So operating margin less financing is self-explanatory. And then you get your cash from financing, 30 million, which is expected to come in 2020. I'm looking at 2021 column, by the way. And other uses, $500,000 for, that's Cal ISO deposit. And then you have 5 million for your collateral deposit, and then, which is totals 5.5 million. So your net surplus is 35.2 million. So that's that's in 2021. So that's the, and then the final row, so item number 7, it shows a cumulative net surplus, which is the ongoing addition from the previous year. Any questions on this slide? So again, this is the base case, right? The starting point. And what we're going to show on the next slide are the different sensitivities. So the different levers you can push and pull and what that will look like to your operating margin.
What is that? Oh,
I have a
ahead,
question.
Bill. Go ahead, Bill.
Maybe this goes back to item 1. Maybe this is for Cody or Sean. It looks like in there that is the collateral deposit considered an expense, the way or an income there. The deposit, meaning it looks like cash from financing, 5,020, 5,021. That's 35,000. That's the 35,000 we talked about before. Then the 5,000 collateral deposit is that I can't. I'm trying to do the math real quick there.
So it's not an expense. Well, how do I explain this? So it's not an expense in the true sense because it's not being spent.
Is it considered separate from the 35 above or a subset of the 35 above?
So it's not, just to be clear, it's not 35. It's for 2021, it's 30.
Right, but
Right.
I'm adding the 5 from 2020.
Okay. So basically you can, we're just trying to calculate what the net surplus is.
So Sam, maybe this is Cody, maybe I can help translate Bill's
Okay.
question to you.
Okay.
He's I think, Bill, tell me if I got this right. You're asking where does the cost of that $5 million collateral come in? So it does not show up as a deposit because it's just sitting in a bank account collecting interest. What we do have to do is pay interest on that funding. And Sam, that's might be the question to you is where does that cost show up? Is it in our payments to our financing?
Yeah, so that's in the category of financing, category 3 above. So the interest amount is 1647, for instance, and the principal amount is 1047.
Let me take a cut at answering the question. The deposit it's a use of funds, so it's a subtractor. So basically, if you look at this pro forma, we have the operating margin that's positive, 13.4 million, call it. We have the principal and interest payments, so those are negatives, right? So net of that, we're left with 10.7 million. That's kind of in the middle there, operating
Right.
margin less financing. Then we have 30 million coming in from the bank, right? So that's positive. And then these uses are negative. The signs may be a little, confusing because they're positive numbers, but those are actually subtractors. So what's net there in the net surplus? It treats that $5.5 million as a subtractor, right? So even though there's still assets, those are deposits, and those would be assets of SDCP. They're not part of net surplus. Net surplus is basically cash over and above those uses.
So in our prior conversation, Cody or Sean, we talked about going forward to the board with River City for 35 million. Remember that about an hour ago? Okay. And we're saying of that 35 million, that the 5 million from River City, from Blue, from our collateral is sort of pulled us out of the 35. So we're really only having 30 million in
Usage?
yes,
No,
available cash.
Yeah, I'm sorry. So this collateral deposit is something completely different.
Right.
Yeah.
Okay.
Yeah. Sorry for the confusion there.
Yeah.
Okay.
Yeah.
So we have
this is for
35 million from River City to liquid to spend. And then we have this 5 million, which is put off the side as a security in case something goes wrong with the 35.
And John, will you please describe for Bill then because the 500,000 for CAISO is obvious. What is that 5 million then for that you've got?
So thank you. The 5 million is collateral that SDCP would post to back its power purchases.
Right. So that goes
Right.
into the box, right?
Yeah. So it just happens to be 5 million, and that's why I think there's a little bit of confusion. Yeah.
That's fine.
You're saying that is not the Emerald Blue 5 million.
No.
That's correct.
Oh, well, that's not self-evident. Okay.
No.
It's just the exact same amount, and it says collateral.
Yeah.
So you might want to clarify that
We'll clean
when you
that up.
send this slide. Yeah, clean that up. Thanks.
Yeah. Thank you.
Yeah, so it's think about it as, we call it like a lockbox reserve. And when we start doing deals with counterparties, they kind of want to see money in there as some sort of collateral before they start doing deals with you.
That makes sense. But can you understand to the common man why
Yes.
it's easy to conflate these two items, 1 and 2?
Yeah, absolutely.
Okay.
Yeah, that's a good question.
Yeah.
Because I'm not a financial genius like Mark West.
Oh yeah, that's it. I'm yeah.
Okay, sorry, Sam. Go ahead. You asked me if there were questions on
no,
the
please.
slide. I did. Okay, go ahead. Keep going.
Okay. Next slide, please. So here are the sensitivities. right? So just to
Jeez.
show what the sensitivities are, looked at, always starting out with operating margin with no discount. So here is the 13, you see the same numbers as before from the pro forma. So with the operating margin with a 1% discount, your operating margin would be, so let's say 2022. I like using 2022 because it's more of a full year. So 2022, you're looking at, without a discount, it's 27.1 million. With a discount, with a 1% discount, is 19.9 million. So looking at a downward change of about 7.2 million. And you'll see that's between 23, 24, 25. So you're looking at an average of about 7.4, 7.5 million over the 4 years in terms of what it would cost you to 1% discount. And just for as another scenario, you just showed what the operating margin will look like with a 2% discount. And with a 2% discount, it's just a doubling of it, but I just thought I'd show it to be easier to see visually, so you don't have to do any quick math. Your operating margins would be in 2022 12.7 million, and then it's a difference of 14.4 million, which is the double of the 1%. 4.4 million in 2023, 19.8 million in 24, and 37 million in 2025. So that is. No, go ahead.
When we did this pro forma, this was the same one we did that we kind of got initial look at in, God, it seems like it was like 3 years ago, but I guess it was just a couple of months ago. But these are the same pro forma that was done then, right?
Cody or Sean, can you guys answer that one? I don't think so.
No.
I'm not sure.
So this is updated data that we're looking at today.
Yeah.
Okay, that's good.
Yeah.
When was it? And when was it? I'm sorry, Sam. I didn't mean to interrupt you, but when was this? When did we run this pro forma last? I'm just curious. I'm trying to base it on when in the reality of the world that this was run.
So this one is say as of last week.
Oh, good, perfect. Okay, thank you.
Yeah. The other thing we thought might be interesting is what it will look like if your operating margin, if you were to increase your renewable targets, and put that renewable and GHG-free targets here, because if you increase your renewable, your GHG-free also increases because renewable is GHG-free.
Mm-hmm.
So the impact would be, again, looking to 2022, it started out with 27.1 million, then your operating margin would be 21.9. So say 22 million, so it's a difference of about 5 million in cost to your book, to your margin, and looking at all the way to 2025 up to 5.8 million, so about an average of 5.3 million over the 4 years starting from 2022. And the other sensitivity we did was on the GHG-free targets only, so not doing anything with the renewables, so specifically on just raising your GHG-free targets. Just a 5% increase there in 2022 would give you an operating margin of 25.4 million, so it would cost you 1.7 million to increase your GHG-free targets in 2022, and it goes higher in the out years. So you'll see 2025, it kind of tapers off because you're already hitting a higher renewable target as it is.
Mhm.
Questions on this slide? These are the sensitivities.
It gets better on the next slide, you guys, because it actually brings it home. So
Well, let's get to the next slide so we can see something good.
I think it's better that's my opinion.
Okay, so this slide, we put together some possible scenarios to consider, just to combine some of them, just so you can see what it might look like to combine different ones. So the scenario 1 is the starting point base case, if you will. That's the status quo. You've seen that before. Scenario 2. So this would be just shows what a 1% rate discount be with the current renewable targets, but with a 5% increase in GHG free targets. Your operating margin, so I actually broke out the discount and the increase there, so in case you want to look at it, but you look at the operating margin in 2022 goes from 27.1 million to 18.2, 19.1 in 23 to a little over 10 million in 23, and so on. Scenario 3 is just a flat 2% rate discount and no changes to anything else. And you're looking at a operating margin of 12.7 million in 2022 as a net result. Just to give you a visual, there's a chart down here to see what the operating margins will look like under the different scenarios. Scenario 1 being the blue one, which is the highest, and scenario 2 in the middle, and scenario 3 is the green one, is the lowest one there. So give some time to think about it, and you can come up with any scenario you guys want to, but just probably throw out some scenarios here. And let me know if you have.
Okay, so Sean.
Uh-oh.
So I'm trying to figure this out between the difference between the red line and the green line, and how much of that is a factor of the discount, and how much of it is a factor of the renewable targets or GHG target differences.
Yeah, don't ask me because I didn't do this. So let's kick this one to Sam or John
Okay.
to explain it better.
Okay.
Sorry, say again. What's the scenario?
There's a difference between the red line and the green line, but there are two variables that have changed. One variable is the discount rate, and the other variable is the targets and the targets. And I'm trying to figure out how much of that difference between red and green is because of the target, and how much of it is because of the discount.
Yeah, well, I think each 1% discount is about $7 million, right? So I would say, 7 million of the difference is from the rate between the two scenarios, and the rest is from the change in the GHG free target. Does that make sense? So
okay, but John, if we take 2022, the difference I'm really trying to do the math quickly, is about 6.5 million between 18.2 and 12.7 operating margins. Look down the 2022 column.
He's talking
right there.
Yeah,
that's it. Okay, so between the two, that's approximately 6.5 million.
Right.
And you said 1% rate discount was worth how much?
In that year, 7.2. That's from the prior slide. So then the difference between the 6.5 and the 7.2 was at 700. That would be the savings when we're going from scenario 2 to scenario 3, where we're saving money on
2 to 3 is what I mean
on the GHG, right? We're saving money on cutting back the GHG going in that direction. So that we're saving the 600,000, but then we're costing ourselves the 7.5. The 7.2 by increasing the discount. So that net is the 6.5.
Okay, is that everybody concur on that's what that means?
That's how I understand it.
Yeah.
Okay.
So John and Sam, can I ask for just a quick recap here? So let's just take a look at, so just to be clear, scenario 1 is essentially base case, right?
Yes.
Okay, so that's base case, which is somewhat similar to the financing.
It's not. It's exactly the financing plan. Yeah.
Okay, good. Okay, thank you. Okay, so that's scenario 1. That's the most conservative estimate there, and it also does give you the greatest operating margin over time. And then if you move down to scenario 2, you've got a very modest 1% rate discount. The current renewable target sorry, I'm going to ask you to go back. It would be, what is that renewable target in the assumption?
You go back one more. One
No,
more.
I'm just asking you. We don't need to jump around, but what is it? It's 50%, right? In
For
2020.
2021, I don't remember what it was for 2022 off the top of my head. I think it was 52%.
Okay, it's 52%. And then the GHG in scenario 2 is how much?
Can you go back to the previous chart? I mean, one slide back. One more. One more, sorry. You one more. Yeah, that right there, yeah.
Sorry, this is something we should have asked you to do because I think we need to kind of like, we need to get to the heart of the matter here. So what is the GHG free content in scenario 2 for 2021 and 2022? Can you say?
So it'll be 5% higher, so it'll be 52 plus 5, 57, it'll be 62%.
In 2021 and
2022, no, in 2022, it'll be 62%.
Okay.
In 2021, it will be 65%.
Okay. Okay.
No, I'm sorry, 55% and then 62%.
Okay. So Mark and Bill, are you guys kind of following what I'm doing here? So I'm just sort of getting down to the short 21, 22, which is our enrollment. Those are our enrollment years, right?
Yep.
And I also, Cody, and stop me if I'm speaking out of turn here, but I'm really also thinking about this in the context of how we communicate this to our customers, you know, and how you talk about it and how we market the program, right? So the scenario 2, you know, is the middle here. It's not as good as anybody hoped for, but it's also not zero. And so I think it's an interesting one to focus on. And I guess my question back to John and Sam would be, if you looked at scenario 2, for example, and you changed the RPS content to a combination of PCC1 and PCC2, can you buy yourself a little bit more room, either on the GHG piece or on a slightly better discount? And I'm not sure, you know, guys, I'll opine here and say, with other CCA launches we've had, at the end of the day, the discount, whether it's 1% or 3%, the actual reality of that in people's pocketbooks is fairly de minimis because it's a discount on the gen rate. So it hasn't really been a major driver in terms of opt-out.
Sean, I'll add on to that though. From a commercial and industrial standpoint, it is more significant. So I would not dismiss it completely.
Fair enough.
Another thing I would add on here, because I feel like we're diving so far in the weeds, potentially people's heads are spinning. This is, again, general direction. So Bill and Mark, what you could do is say, we want to see a discount and more renewable, and we could play around with more of the numbers. You don't have to do all the math right now in front of us, and we don't have to get to a specific number. So you can just more general direction to alleviate all the live math that we're trying to do here.
Well, that's true. And one of the reasons you do subcommittees is to beta test the presentations before they get to the full board. Because if Mark and I don't understand it, A, we're not going to understand it at the next level. And B, there's a good chance the other three aren't going to understand it. So this is the chance to correct things. Don't take it personal if we say, wait, you got to fix that, because that we're trying to get everything lined up for the board to make the full decision.
And I think also too is that these scenarios that you put in place, I'm not 100% positive that they're what made, okay, so my question is, what made you, I know scenario 1, I got that, I understand what that came through, that's just standard operating procedure almost. So you came up with scenario 2 and scenario 3. Is Cody, did we base those, getting these 2 scenarios, did we base those on the past discussions that the board has had? Is that how you came up, is that how you picked those 2 scenarios?
We were looking at, rather than having you all have to do math in real time. We were trying to provide a couple of options to show you. Here's if we could guess at what you might be interested in, which my opinion is you were thinking about discounts. And then
Well,
also
that Cody, that is extremely important to me because
Yes, me too.
as one of our, my city, that's important for us. But I want to make sure that, especially in the first year, I definitely will think that we're going to want to make sure that we're rolling that out because that's a feel good story that we need to provide to our customers. But I'm wondering how we pick the other parts of the scenario.
And this is where I'm suggesting, and Sam and John, you can correct me if
Yeah.
I'm confusing things, but what I suggest is you, Mark and Bill, give direction on, we're interested in seeing priority number one is, and I don't want to put words in your mouth, I'm guessing it's a discount, and then priority number two is increase in RPS and greenhouse gas free. And here's our kind of general tolerance. We kind of like, whatever scenario you kind of like, you're comfortable with those numbers, and then they can play around with them further. You're not actually setting any rates or anything until later in the year.
Yeah.
This is all just general direction, and this will change later.
It'll change multiple times as we move forward, honestly, right? Well, not big, not great changes, but it'll fluctuate a little bit based on what's happening in the market at that time.
So here's what I value, and then you can figure out how to translate it into numbers. We're a baby organization. We've got to survive. SDG&E is probably, even if they're listening, it's probably not our 100% friend. They're sort of, I call them our frenemy. And so we have to be able to show to the public that we're at a lower rate than SDG&E. Even if it's only 2%, it's lower. It may not make a huge difference, but that's what we promised people when we started this thing. So we have to, at least in the early days, we have to prove that we are more efficient than SDG&E, at least in how we charge. That's a high value. Here's the other high value. I have an obligation to my city and taxpayer to meet our climate action plan. So every time I look at this, I think, am I on track for the climate action plan? Which is why, Sean, when I asked you, I can talk to you about a 6-month to 1 year plan, but once you start showing 5 years, my answer is, I don't know. Is this lining up with my climate action plan? Do I have to basically take my climate action plan goals and just map it out? So that's why I really want to talk about a 5 year. And with all of these charts about 5 years, it forces us to talk about 5 years. But throughout this entire time, what do I value? I value being able to survive in the competitive market with SDG&E, and I value meeting my climate action goals. I don't know if these meet my climate action goals, and probably the answer is your climate action goals aren't going to be completed until 2030, Bill, so stop worrying about it. But someone in my city will take this and say, hey, if I project these numbers out to 2030, those are the two things I value: consistency with my plan and being competitive with SDG&E.
And I would also say, Bill, and I'm correct me if I'm wrong, but if we're not on track, whatever our climate action plan is at 2030, we need to make sure that we're on that track as well to meet those goals. And if we're not, I don't think our cities are going to be real happy if we're not, and then 1 year later we're there, So I need to know where that.
Right. When we were talking about, hey, give us direction for the next year, my answer on the climate action plan, this is just 1 year. This isn't the whole plan. Yeah. But every time we throw a chart up that says 23, 24, 25, 26, 27, then that's showing a trend, and then we have to be accountable for the trend.
Yeah,
right.
I understand.
So one thing I would suggest maybe for Sam and John in the next round to be responsive to what you guys are talking about. You did a very helpful bar chart on slide 14 that basically shows SDCP, SDG&E, and the California State RPS and how it tracks to that. You could do something similar probably based on your climate action plans. And Cody, I don't know how different each of the member agency climate action plans are. I'm assuming many are pretty similar, but that to me would be something to be added, and I don't think it would be too hard to do. that would be responsive to what you're talking about, Bill.
Yes, and I meant to ask you this question, Sean. In the other JPAs, and let's take the big one in LA, I'm assuming the different cities have different climate action plans. So do they make individual city choices, or do they amalgamate it, or does whoever can get a majority forces their choice on the minority? How do you do it when you have cities with different plans? How do they sort through that in a JPA?
I mean, lots of people on this call can
So-
speak quick and say that it's generally an aggregated approach. So each city doesn't have its own power portfolio that matches its own climate action plan. So it's that regional approach that we talked about when you guys formed the JPA. But I think in an aggregate, you can look at how it's being responsive across the board to each climate action plan.
And just to remind you, our JPA has a target in it. So collectively, that
Yeah.
was one of the things we talked about collectively amongst the cities, is we had to set one target. What I think Board Member West mentioned earlier is that different cities within the JPA can opt to go above that target.
Yeah.
But we're not going to try to track all 5, or if we grow 5+ targets and hit them individually, unless that city says, I want to go above the JPA procurement plan.
And Sean, if hypothetically one city really wanted to go full tilt, didn't care about the price and wanted to be 100% renewable tomorrow, are they even allowed to break away and do that, or they still have to fit with our aggregate approach?
Well, I mean, assuming that SD,
I don't think that's going to happen. I'm just as a theoretical question.
it's certainly permissible. It's happened before. So you would have, let's say, 2 products when you launch. One is your default baseline, and then your other is likely to be 100% renewable at a price premium. That has not been determined as yet, but a city could pass a resolution to enroll their entire community at the higher level with the option to opt down. And we have seen that in other CCAs. So that's a separate discussion, but it's certainly an option if a city chooses to do that on a citywide basis.
And that's not that unusual, is it, Sean? I think that there's a couple of them. There's a
Yeah. I mean,
more
it's
than
not-
one.
It's not typical, but it happens, like, for example, with Clean Power Alliance in LA. There's a number of cities that have enrolled at the 100% level and allow customers to opt down if that's what they want to do. Peninsula Clean Energy has a couple of cities that have done that. Most CCAs, to be honest, their cities enroll at the default product and allow customers to opt up voluntarily. But again, that's a later discussion, but it's certainly permissible if that's, what you guys want to offer up.
Just to clarify, why would that be a later discussion if what we're talking about is giving guidance of what our power portfolio would be? Wouldn't that be a current discussion if hypothetically, Encinitas or La Mesa wanted to go full tilt right now?
Sure, I think it's something that should be noted as an option under your 100% renewable option, because I believe that is within SDCP's implementation plan currently.
Well, I was, and Bill, just to kind of go to your point here, I was going to make a recommendation that as we move forward, we do one scenario that is full tilt, environmentally friendly, and then we do one that's a little bit, kind of along the lines that they're talking here, but that has a larger discount. So we can show the delta between the two very easily, and not go out as many years as this is, and make it more focused where we're really making decisions based on the I would even say just for the rollout time frame to do this. So we're not looking really far down the line.
Is that something that makes sense to me, Sean? Is that something we can do now or not?
I'm going to defer that one. Yes, I think, but I want to also bring John and Sam and Cody back into this conversation.
Okay. Sam or John or Cody, do you want to answer that question or comment?
Yeah, John, maybe you want to take this one. I mean, you have more experience with MCE, and you have a lot of different cities as members, and how it's addressed and thinking about it.
Yeah, so I mean, a lot of things are possible. The ideal would be that you'd have more or less a common portfolio, then you'd have options, for customers to opt up to maybe 100% renewable or something like that. It gets down to ultimately, I think we can handle it on the power procurement and portfolio management side. It does get down to, I think, rate setting, and so if you have multiple kind of portfolios and each city is maybe choosing which the default is, you could wind up with different rates across the areas, and I think that can get a little bit a
John,
little bit unwieldy.
yeah, John, maybe what I'm wondering is I'm not asking for a multitude of, I'm asking for like two different plans. One that is one option that shows this is meeting our highest GHG free targets, but it doesn't give them much of a discount it doesn't have a rate discount. Show us that. And then the other one would be a higher rate discount and just meeting the GHG free target. So in other words, you can see, I want to be able to show the rest of our board that these are the two extremes. One is climate action plan or exceeding the climate action plan based, and the other one is rate discount based.
Okay.
Can we do that?
Yeah, I think we can do it. I think what we're trying to show with this presentation, with these numbers, is that that range is pretty narrow. That feasible range is pretty narrow based on current market conditions. I think looking at discount options, the margins are very thin if you start to get into discount scenarios. So I'm not sure that you could really look at a deep discount and have a viable program. So that would be just kind of my reaction to that is, I think at this point, best information available, the feasible kind of ranges are pretty tight. And I think we've tried to capture, on the environmental side, if you want, I mean, obviously if there's a willingness to pay more, then, we can be more aggressive on the environmental side. But if not, if sort of parity is rate parity or better is the target, then I think the kind of the ranges that we're looking at here are what's feasible. That more 5% increase in GHG free, and then on the rate discount, I would say even the 2% is aggressive because it just doesn't leave enough margin to even repay the principal on a reasonable time frame. So I just feel like right now we may need to just hone this in a little bit and present it a little bit more clearly. But I think we're somewhat limited in under current market conditions about what's looking feasible.
Yeah, and just to add to that, so in coming up with these scenarios, you can almost say that I backed into them, right? Because in terms of what reading the JPA, reading the newspaper articles and the different things, the thing that stood out to me was, well, maybe two things stood out to me that were equally important, but one of them I would even rank higher, and that's rate discount. That seemed to be an important one. And the other one being, of course, higher renewable than at least that SDG&E. So if you look at scenario 3, what I did was I basically played with the different discount numbers, and then, putting a 3% discount in 2023 will put you in the negative. So basically 2% discount is the best we could do at
Gotcha.
current conditions. So that's how I ended up with scenario 3. Just FYI. Scenario.
Well, Sam.
Yep. Sorry, go ahead.
I would just say, Sam, that's exactly what we need to hear at the board, because that what you just said right there is hits on the head what we have been talking about, and I think that wasn't clear in the slides getting to here. So
okay.
So that's great. That was if that scenario 3 is what we have been talking about at the board, somewhere that needs to be said so we can understand that.
Okay.
Yes, I would say put scenario 3 forward. The question is, should we add something different to be more consistent with what Mark had said earlier, the way he described it as a,
Environmentally,
the most
ex-
the most aggressive, clean, early.
Yeah.
To show a contrast. But scenario 3, we have to put. Well, I want to put forward, number one, it meets the objectives of the 2% discount, which is what we never officially promised to everybody, but it was definitely in our, it was definitely in our sales documents.
Yes,
So,
I agree. Bill.
yeah.
So
Right.
guys,
And for scenario 2,
Uh-huh.
so I just want to tie up the scenario. So in terms of pairing it, so I was thinking about scenario 2 with the 2% rate discount. How could we make it even more attractive by making it, including the green or the GHG free factor? And even as you can see with 5% GHG increase, that's like a $1.7 million impact even in 2023, which would bring you down to just over 2 million in operating margin, which I think is cutting it way close. So that's why scenario 2 ended up to be a 1% discount. So that's just to show you the logic that went behind it. But
Sam, you're saying your scenario 2 with the 1% rate discount and the 5% increase in GHG target, that's as far as you could go without crashing it?
no, but that's to include the discount. But if
What if you remove the discount?
then that's a different scenario. And that's the other question is it more important to be renewable or GHG free? Because those are two different things. Also, this one, there's no scenario here that takes into account more renewables.
I think what Bill and I are telling you is I think that scenario 3 is easy. You need to say, hey, that was what you guys have said in the paper and all this, but we wanted to give you a scenario that shows you the most aggressive environmental portion of it as well.
Okay, Mark, I think maybe the question might be, they concede what you just said, but is scenario 2 more RPS or more GHG, i.e. the GHGs, we start talking about hydro again, and we start talking about nuclear again, as opposed to the other types. Sam, is that also the question?
That's
on
right.
the table? Okay.
What
What do you think about that?
It's more expensive to be renewable than GHG free.
Right.
Yeah, it is. And I'll be honest with you, I'm a surfer who I'm not a huge fan of standing oak spray, but large hydro in nuclear are very affordable. I mean, there's not a lot of it here in Southern California, obviously. Last time I checked, but if I don't want to remove that from our funding, remove it from our portfolio yet. So are we making
I
this
agree
more
with you
difficult?
on that, Mark.
I'm sorry. Are we making this way more challenging than it needs to be? But
No,
I just want to.
This is a good discussion, I think, and you guys are getting to the heart of the debate the board will have to have now and over time is this push and pull and what these levers do. So I'm hearing good direction from you all, and I just want you to know that this is helpful.
and I would say, guys, my recommendation here would be to move to the next slide, because that's going to distill in time the time that we have remaining, because we're running over. This is what
Why don't John and I take this back also? I think we have a good understanding, and then we'll also talk to Cody and Sean to make sure that what we bring back here makes sense. But I think
the only qualifier to make before we move on is that the other overlay here, which we will take into account, is that the bank is operating on a very conservative scenario. So that's also going to be a balancing factor going forward. Just Bill and Mark, just to keep that in mind.
Yeah,
Okay?
I got you. And I remember that was said in the beginning. Yep, I got it. Okay, move forward.
And maybe to put a fine point on that, what Sean just said, that the bank, River City, will need to approve our current pro forma, whatever we choose now, and then we need to finalize with them before we, at the end of the year, we'll need to finalize a pro forma with them too. So while understanding it may change, the direction you give us needs to be balanced with what they're comfortable approving at this point in time.
Gotcha.
Okay, so I think we've had some good discussions here, just talking about direction on phase-in schedule. I think that one relatively straightforward. Do we have direction on that one in terms of the latest phase-in schedule reflecting the
Yes.
resolution?
Yes, I'm completely comfortable with the phase-in schedule that you guys proposed.
Okay. And I guess on rate discount and portfolio options, we have some homework to do on that one.
Yep.
Okay. And just to say it again, we're going to revisit this topic again. We put later this year, and could be next month, depending on what changes or doesn't change. But this is a living spreadsheet, and we have to be able to adapt to the environment and to make sure we get best portfolio strategy possible.
Hey guys,
Go on, Sean.
before we totally wrap it up, I think we heard pretty clearly from Bill and Mark that rate discount, at least for the default product, is an important lever that we'll keep working on. I didn't hear much on the portfolio option, so can I get a sense from you guys about what's more important to you, the RPS versus the GHG free? I mean, how much latitude do those guys have and do you care whether it's PCC1 entirely versus some mix of bucket 1 and bucket 2? Can you say more about that?
Mark, go ahead. You said it and I concur. Do you want to restate it?
Man, I'm trying to remember exactly what I said, but I think that the higher, I don't want to remove any of the GHG free, but I want to make sure that our RPS is as high as it possibly can be. Is that clear enough?
I think if this is Cody, if I could reiterate what I heard and tell me if I'm right or wrong, but you do want to maintain the RPS as high as possible, right? That's the more expensive power, but that you're comfortable increasing greenhouse gas free. And I would, this is my own description, but if we're all trying to achieve climate action plans, we're looking at greenhouse gas reductions. So greenhouse gas free power really supports that. So you're okay adding those in as well and increasing those in order to reduce the greenhouse gas content of our overall portfolio. Is that right?
Yes.
Okay. I think.
Bill, I don't mean to be speaking for you.
No, I concur.
And I'm hearing PCC2 is a viable option as well.
Yeah.
Okay.
This is Cody. I'll chime in while they're thinking about that. But in our JPA, we did talk about avoiding that as much as possible.
Oh, that's right. I'm sorry. I forgot about that.
That's okay. We didn't eliminate it completely because of these reasons that we want to balance achieving our greenhouse gas reductions with costs and the realities of launching as a startup. So we're going to look at those balances, and that's what we're trying to present to you now.
Yeah, I mesh those two inconsistent thoughts by thinking, well, maybe it should be almost all hydro.
Yeah.
Or that doesn't pencil out.
All hydro is greenhouse gas free, but it's not RPS compliant.
Yeah.
It's category 2.
Okay.
Hey, Cody, really quick, I thought that the JPA agreement said that we wanted to stay away from bucket 3 RECs, but does it include bucket 2 as well? Avoid the use of bucket 2?
I believe so, but I'll confirm.
Okay.
Yeah, I think we looked at it together. I think at some point, and it said
it did. I'm almost 100% positive.
All right.
It said wants to avoid it, but it doesn't say to leave it out altogether. So.
Okay, so let me ask the question in English. Is the hydro nuclear discussion we just had inconsistent with what our JPA document says?
No, I think it's still in there. We wanted to try to avoid it that's how I understand it. Cody, am I wrong?
But the common sense use of the word avoid is not to put it forward as a viable option.
Yeah. Yeah. Cody, help me out here.
Right. I think it's to not rely on that explicitly as a crutch to get to all of your goals. But I think the realities of the reason we did not put avoid is for this reason, that the realities of the costs that we're entering and the goals we're trying to achieve, we have to look at balancing things.
Yeah.
So I think to help us along here, I feel like we have sufficient discussion for this and direction on this discussion, and also some good input on how to help clarify this conversation for the full board.
Thinking ahead, everyone, if the entire discussion at the board is now a new fight over hydro and nuclear, we're not going to be able to talk about all the important stuff here. Is this just going to be is this going to be the tail wagging the dog?
Just to be clear, when you say hydro versus nuclear, so
hydro and nuclear versus yes or no to them. Yes or no to them is what I meant to say. I mean, yes or no to nuclear, yes or no to hydro is what I meant to say.
But they're both GHG free. They're not PCC or PCC1.
Correct, but think about on nuclear we did explicitly put avoid, and in hydro, is our bucket limitation apply to hydro or not? That's what I was trying to get the answer to that, Cody or Sean or Sam or John, whoever, Mark.
Okay, but okay.
Is there something in our JPA document that limits hydro? That's the direct, simple question.
Not that I'm aware of. No. However, it is limited by the fact that large hydro in and of itself is not compliant for RPS. So I think we don't.
It's only.
I recommend.
So, hydro and nuclear are GHG free.
Yeah, they're GHG free, and so they satisfy that requirement. So I recommend that we don't do a deep dive on that on the 23rd, because it's also a resource issue that we don't know till you go to market. So I think you should leave it at the higher level rather than diving down into specific resource types.
Yes, I agree with that. The question is, are we going to be able to avoid that based on the way we're talking about it now and the way the documents show?
I think so. But Cody or anyone else?
Not trying to hide it,
Ryan.
but that's not the highest and most important concept to discuss right now.
This is Ryan. The nuclear hydro issue is in the recitals. So the recitals are more of a preference. They're not legally binding on the JPA agreement. The bucket 2 and 3 rec issue is in the actual agreement itself, and it says that the JPA shall avoid it to the extent feasible. So if that provides any clarity, that's what the JPA says.
So that tells me that we can use the hydro and nuclear, but we need to stay away from bucket 3 and 2, right?
That's how I read it. There's a preference unless it's infeasible to do so.
Right.
Got it.
I'm not sure it's that liberal on nuclear, but maybe that's not even the technical document. Certainly the debate around this was certainly that nuclear was going to be almost like a last possible option, and that's what the tone.
Don't conflate the discussion around bucket 1 and bucket 2 and bucket 3 with GHG free resources.
Yeah,
okay,
that's what I was getting at.
You got it.
Good.
Okay, gotcha. Understand.
That's
separate
excellent.
the 2.
Two separate issues.
Yeah,
Thank you, Sean.
one's renewables, one's GHG free.
Yeah.
Sean is so smart. She is so smart.
I just used to be an elected official, so we need to speak plain English.
Yes. Why did I have the sense you've had scars over that issue? Perhaps that was just my imagination.
So hopefully it doesn't close the door on some level of bucket 2, but we can discuss that offline and figure out if it's even worth, if it offers enough of a financial break. It might not be worth it, but it's worth discussing.
Yep.
We got to discuss it, because I when I put my surf rider hat on, I'm like full on none of those other things, but I'm a city councilman from my city is not very affluent. So I gotta have that hat on too, if you know what I mean. So I gotta balance those.
Well, Mark, can I ask you to think about something? What if we didn't add this full tilt schedule 2, and we just said, look, our recommendation is schedule 3? I mean, Yeah.
Option
Option
three.
three. Scenario
I-
three is what I meant. Scenario three. By keeping scenario 2 there, it's going to raise that discussion.
Could you go back?
Slide 18. That's my
Yeah.
that's the major takeaway from today.
Okay.
And I think there are ways to do that. But
Yeah.
I think scenario three is further away from the bank than the bank, you know, and Rosa's sitting here. I don't think we need to get into this, but I don't recommend right now that you guys do that. So let us play around with the feedback that we've gotten and tweak the scenarios 2 and 3 to see if we can get to something that's closer, but that would also satisfy the bank.
Well, that's a significant variable, and I'm glad you raised that.
Yeah. Here's the thing, Sean. I think, and Bill, correct me if I'm wrong, but the problem with that slide is not the slide itself. It needs language on there to just lay it out.
Yeah.
So
agreed.
that's what I need, so we can show our people, because the number, you know, it's good, but if you can get that to where it says this is this, bam, 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 this is this, bam, bam, bam. You know what I mean? So
I think I agree with Sean, and I think we have enough feedback, and we know where to try to go to balance this with what we need to keep in line for River City, and try to appease everybody all at once, and we'll clean this up and bring this back to you all.
sounds good.
Right. I appreciate all the feedback. I know this is in the weeds, but these are the types of discussions that are helpful. One, for this committee, but this is the sausage making that goes into this process.
Okay, well, this is not an action item.
No.
Right.
This is not an action item, and there's no other items on the agenda. So are we concluded then?
So I just, before we conclude here, I just want to add that these were just operating margin results, but what I didn't add on here were the debt repayment amounts, the interest and principal. So that 2% might not even be a viable option. How did I think?
Oh, well, that's an important variable too. Okay.
Yeah. So we're going to take
that's an important late add-on.
Yeah.
No, I just.
Hey, Sam, I'm gonna recommend you put that on the first slide from now on, because that would have helped us out a lot.
Okay.
It's okay. We're all working through this together.
Yeah,
And if there's
no
any
worries.
from
So
the
I do
public
think
still
that
watching that, we're young and we're figuring this out.
Yep.
So to your point, Bill, that the ask was for direction from the board, and I think, or from the committee, and I think we got what we needed. So thank you.
Okay.
Okay. And there's no other actions there's no other items on the agenda. So if we can conclude, is that okay with everybody?
Yes,
It's
we
really-
can go have a beer now.
Yay.
Yay.
Okay. Thank you.
Thank you.
All right. I'm just going to hang up. So goodbye, everybody.
Goodbye. Thank you.
Meeting adjourned.
All right.
Thank you.
Bye.
Bye.
Thanks, Cody. Thanks,
Thank
Johnny.
you. Bye.
All right.
Thank you.
Bye, everybody. I think I lost you for a second. I'm back now.